All right, welcome back. In this lesson, I'm going to teach you what a CPA has coined capital equivalent value. I've worked with this CPA, Brian Bloom, for a long time. You can look him up on Amazon. He's got a couple of books called Confessions of a CPA. He's coined this term of capital equivalent value. And the idea is, how much money do I need in a traditional retirement account to generate the same amount of cash flow that life insurance can do during my retirement years? Now, this is a high level educational piece. I'm going to pick a few numbers. Numbers obviously vary. We have a lot of varying conditions like market rate of return, future tax rates, things like that. But I'm going to be consistent in this example and hopefully give you an idea of how to compare what you're on pace for or what traditional planning teaches versus what life insurance can do. Now, mind you, in this quick video, I'm not talking about the accessibility, how to use money before I actually get to retirement. That's what we've already covered. The purpose of this is, let's say I do follow the traditional method. How much money do I actually need, or what rate of return do I have to chase to duplicate the boring rate of return of life insurance? And I think the answer is going to surprise you. So get your notebook ready and let's dive in. All right, let's dive into the capital equivalent value. Let's say I'm trying to achieve $100,000 of cash flow in retirement, and my retirement is from age 65 to age 90. Okay. Now, when I say $100,000 of cash flow, that means I want $100,000 of money that I can spend. It's a big difference here. And I'm going to go through what that means, because when I take money out of a traditional 401k, I'm probably going to owe income tax. I might owe estate tax. I might owe a local tax depending on where I live. So if I want $100,000 of cash flow, what size 401k do I actually need? And then I want to compare it to life insurance. How much cash value do I actually need to duplicate the $100,000 of cash flow in retirement? Now, I'm going to go through this kind of slow. You might have to watch this video a couple of times because I'm going to run through some calculations. And the cool thing about videos is you can always pause it and then rewind and watch it again. So let me start off. When I have $100,000 of cash flow from life insurance, I have benefits. I have long-term care built into my plan, which means with life insurance, I have a really big death benefit. The insurance company, if I get sick and don't die, like if I get dementia or need to go to a long-term care facility, there's a cost to that. Well, the death benefit can help pay for that cost, right? Also with life insurance, we also know there's a death benefit included. Well, if I'm pulling $100,000 out of my 401k, I would have to pull out extra money to buy the long-term care plus like a term insurance. If I wanted to make sure my family is going to get a death benefit and I'm only living on my 401k, that means I have to go outside and then buy another term insurance product. And there's a cost for that. So let's just say it's 10 grand. Now, a lot of long-term care products are more than that just by themselves. And term insurance also can be super expensive. So this is kind of a conservative guess. Extra $10,000 distribution from my 401k to equal the benefits that the life insurance already gave me. One thing that's not talked about enough, in my opinion, is the taxation of Social Security. So for those of you watching this, Social Security, you pay into your entire working career. They take money out of your paycheck. Your employer might help pay for that. But the idea is after the age of 62, you qualify for the Social Security benefit, and they're going to pay you. The Social Security Administration pays you kind of like a retirement pension. Unfortunately, back in the 80s, they said, all right, that pension that we've set up for you called Social Security, we're going to tax you. We're going to tax you on that. So let me quickly go over how Social Security can be taxable. By the way, I'm dumbing down an idea that literally takes weeks to understand. There are hundreds of ways to actually file for Social Security. This is not a prescription on what to do. This is just a high level, here's how it could work. Let's say you have a benefit of $48,000 a year in retirement. So 65, you go to retire, Social Security gets turned on, and they're going to pay you $48,000 a year. Well, depending on how much income you make or how much money you pull out of your 401k, if you make over $44,000 a year, married filing jointly, then 85% of your 85% of your Social Security is actually taxed as ordinary income. What does that mean? They're going to pay you 48 grand, but they're going to tax you on 85% of that. So 85% of 48,000 is $40,000 a year that now will be put on your 1099 as taxable income. So if I'm in a 25% tax bracket, and $40,000 of my Social Security benefit is taxable, I could be paying $10,000 a year extra in tax on a benefit I've already paid tax on. This is the definition of double taxation. So what does that mean? That means if I want to duplicate the cash flow, I got to pull out an extra $10,000 from my 401k to cover the tax that's due on my Social Security. So I have $120,000 that I have to pull out of my 401k to duplicate the $100,000 that life insurance already gives me. See, I'm upside down already. I have to pull more out of the traditional 401k or IRA and just to net the same cash flow that life insurance could give me. Now, think about this. I haven't even talked about taxes yet. If we are in a 25% tax bracket, and the funny thing is that I find so ironic is that all of these financial planners talk about how when you retire, you'll be in a smaller tax bracket. Ask your CPA, what tax bracket will I be in when I retire? They won't be able to tell you. The only thing that they typically say is, well, you should be in a smaller tax bracket. Why? All that means is that they are telling you that your success means you have to take out less money when you retire. I don't know about you, but I am not saving my money my entire life so that I can retire on less than I enjoyed while I was working. Sure, some of my bills might go away, but I still want to enjoy the fruits of my labor. So if I'm in a 25% tax bracket, how much money do I actually have to pull out to pay the tax so that I can net the $100,000 of cash flow? Well, if I'm using life insurance, there is no tax due because I'm borrowing against the death benefit up to the cash value. So when I take a $100,000 distribution, it doesn't show up on a tax return. Literally, I'll say that again. There's nowhere to put your life insurance distribution if you take it out as a loan on a tax return. It doesn't show up. I used to joke with the CPAs I work with. On your business card, you should write, learn how to never use me. We literally have clients that are living on hundreds of thousands of dollars a year that don't show up on a tax return. Makes it an easy job for their CPA, that's for sure. If I have a traditional 401k, I have to pull out $160,000, pay the 25% tax rate to net $120,000, take the extra 10 that goes to the Social Security benefit I was going to give away, take another 10,000 to go buy life insurance and long-term care insurance so I can net $100,000 of cash flow. So I need $160,000 a year out of a 401k to duplicate the $100,000 that comes out of life insurance. What does that mean? Well, if you follow traditional financial planning, when it comes to a 401k, they use what's called a 4% distribution rate. Safe Money Withdrawal, Trinity Study, Monte Carlo. You can Google all of this. But the professionals say that if you take more than 4% out a year, it's likely you're going to run out of money before you die. So $160,000, if you divide that by 0.04, that's going to give you the amount that you need in your 401k. Now, when it comes to life insurance, this is going to vary based on health and age and sex for that matter. So male is different than female. But if you're standard health, typically you can pull out around a 6% distribution rate and not run out of money. So what does that mean? I need $4 million inside of a traditional 401k to duplicate the net after-tax cash flow with all the same benefits of life insurance. And life insurance, I only need around 1.7 million in cash value to duplicate the same lifestyle. Now, here's the cool thing. People look at this and they go, well, 1.6 million isn't as much as 4. The goal is not account value. Ask yourself this. If I could help you understand how to get a bigger account value or bigger cash flow, what would you want me to focus on? The cash flow. Furthermore, when you're gone, your spouse is going to inherit, let's say you have $4 million in a 401k. Your spouse inherits a $4 million pre-taxed asset that the government requires you to take money out of after a certain age, which is like 72. And the condolences from the IRS is she goes or he goes from married filing jointly to a single taxpayer. Tax rates are higher as a single taxpayer. So they're going to owe a higher tax rate on a massive number. And when both parents are gone and they leave $4 million to their kids, the kids are required to take the money out over 10 years. It forces people into a massive tax rate. You can go on for hours about this. Otherwise, I have $1.7 million in cash value, which is probably going to buy me a $3.5, maybe $4 million income tax-free death benefit. So not only do I know I'm away from market volatility, I'm with life insurance, I'm not paying an expensive asset manager for the rest of my life, I have no future tax liability with my life insurance, I can enjoy the same lifestyle on $100,000 a year of cash flow, and I'm still not taking away from the inheritance to my family. This was massively eye-opening to me as an advisor when you listen to CPAs and professionals talking about how their clients are going to be in a smaller tax bracket when they retire. Yet I've never met a 65-year-old that said, show me how to live on less. Show me how to live on less money in retirement. That is not the goal. The goal is to enjoy retirement. How can I enjoy retirement with making sure my assets don't go away when the market fluctuates? Or if I have a premature death and something happens, my wife is still taken care of, or my husband is still taken care of. Or if I get sick and I have to go to long-term care, I don't want to dwindle all my assets and leave nothing to the family or become a burden to my kids. If you use life insurance, not only do you have access to the money before you retire, after retirement, it generates phenomenal cash flow without all of the risks. I hope this was as eye-opening for you as it was for me. I know I went fast. Make sure if you have a question, leave it in the comments below. And if you want to get help on your specific problem, you can always click that button on the way bottom that says set up a free consultation. You get access to our calendar. You can jump on a phone call for at least 30 minutes, depending on the problems that you might have. Hopefully we can walk you through some of the solutions.